Markets have been reacting to tariffs on Mexico, Canada, and China. A key question for investors, how will the Fed react? Our Steve Leisman takes a closer look at that this morning. Morning, Steve.
Hey, good morning, Carl. Fed Fund futures on the move, responding to tariffs by President Trump by pricing in rate cuts from the Fed much more aggressively. Markets now pricing in 3 cuts from the Fed this year with a greater than 50% probability of a first cut in June, a second one in July, and now a third one in September. But will the Fed come to the rescue, and how quickly? Fed officials have said they're going to respond to weakness in growth and employment, but they can only do so if inflation is headed to the 2% target and inflation expectations remain under control. But 5-year inflation expectations measured by the University of Michigan, well, they shot up recently to 3.5% on those broad tariff concerns among the American public. That's the highest level in 31 years. Market-based expectations are lower but remain elevated. Krishna Guha of Evercore ISI says the road to a June cut runs through this. Moderate tariffs, that would mean backing off the current levels against Mexico and Canada, weaker job growth and declining inflation, along with contained inflation expectations. Markets seem to be betting on that scenario, but the Fed could find it tough to cut while tariff-induced price hikes are working their way through the inflation indices, and until it's clear to policymakers they face one-time price hikes, not a rekindling of inflation. Guys?
But the problem, Steve, is that inflation, as you know, is not really demand-led inflation that the Fed fights. So it feels to me that it's easier for them to cut if we really start to see growth slow down, and particularly that have an impact in the labor market.
Yeah, that's right, Sarah. The trouble is that you can come to one conclusion if you sort of close one eye and look only at one part of it. The trouble for the Fed, I think, right now is the context. You know, they go back to 2018, and you see that the tariffs didn't cause a broad increase in the price indices. Well, inflation was below target then. We'd been through a very long stretch of below target inflation. Right now, if you listen to some Fed officials, they point out, hey, we've been through just a pretty good round of inflation. We're still above target. And so that context is going to give them, I think, a little more pause, suggesting to me the market might be a little more aggressive. You're right. They can respond to weakness, lower job growth, but they're going to have to wait till at least they're sure, I think, these price hikes that are coming from the tariffs just are one time and not rekindling of an inflation psychology among the public.
Yeah, we're back to that argument about whether or not COVID changed our reaction function to price hikes, Steve. A lot more from you later on today, Steve Leisman.